Hi everyone, this is Paul Lange with another topic in a series of free online videos you can find at disciplinedtradingstrategies.com on the free stuff page. The topic on this video is going to be a quick one on beware of these two time frames. If you like this video, be sure to check out all the other videos on the DTS free stuff page. I assume you're aware of that by now if you're watching this video, and also check out the other ways you can get great information for free at DTS. Before watching this video, if you're fairly new to the market, you may want to watch the video called Time Frames that's in the For Newbies section. That covers the basics about time frames, and in that video I refer to the fact I'm going to discuss two time frames additionally because there are some interesting comments that need to be noted about those two time frames. This is the chart that we had up in that prior video, and the two time frames that I want to talk about are swing trading and scalping. They're valid time frames, but they're often very misunderstood. Let's take a look at what I'm talking about. Swing trading, it is true that all time frames are the same from a strategic point of view with a few exceptions. And that means when you have strategies, it really doesn't matter if you're playing a 1 minute chart, a daily chart, a weekly chart, all the strategies are the same. However, the daily chart is something unique. It is the first time frame where the market is closed in between bars. This closure means that sometimes prices gap or move a lot right after the open. This means big swings, but not always in the desired direction. This causes a lot of stop outs and lowered reward to risk. Unfortunately, many traders pick this time frame. Some are told that it's a good time frame to learn on because it is slower. This is not good advice. Let me emphasize this. I think that the swing time frame, while it's a valid time frame, of course, is one of, if not the most difficult time frame to trade for the reasons I'm about to go over. As a matter of fact, I personally don't swing trade. I go from day trading out to a longer view, either a core or a long-term view on weekly or monthly charts for reasons I'm going to explain. If you have been trying to swing trade and having a hard time, part of the problem may be the fact that you're on a difficult time frame, not so much that you are necessarily doing things all that terribly. A lot of times I see trades that are not really bad trades people show me, but it's just the nature of swing trading that you have to be very, very good at and do a few things special if you're going to actually swing trade. Unfortunately, many people are told to practice swing trading on daily charts, and these are often people who can't day trade, so they're told, well, practice swing trading until you're able to day trade, and unfortunately that's bad advice because it is a very difficult time frame to learn. Also, some people are forced to trade this time frame because they don't have the account size needed to day trade, which is what they'd rather be doing. Also, day traders who swing trade often find themselves distracted by overnight swing positions. Because they do not have a lot of wiggle room, violent moves often have them stopping out the morning after the first night you hold them. And to top it off, good day trades may be missed in all the distraction. If you go back and look, I'm willing to bet you that half of your swing trades stop out on the first day you hold it overnight, that second morning, during the first 30 minutes of the day. Very, very common. Go check and see if that's the case. This is typical of what happens a lot of times and why it is difficult. Here is a daily chart, and again, whether you love this strategy or not, you have a major support area, you have what you would call a trigger, and by the way, I do not consider that to be an acceptable entry, but many of you would look at that as being the proper entry. But if you do use that type of entry, you stop out the next day if that's what you're doing, if you're using that stop from the prior day, and then it flies higher. You have the right stock, you have the right chart, but you're not in the trade, you actually took a loss on it. Similar play here. You have a stock that starts moving up very strong, it pulls back to a support area, you think I got this. Again, I'm not sure that is exactly the entry I would want to be using, but if you do use that entry, boom, you think that the trade is garbage, you walk away from it, and then you look at it a few days later and it is a home run of the year, but you're not in it. This is something that happens too. You may be in a trade and boom, all of a sudden one morning it gaps down, flies lower, you lose all your profit, go negative on the trade, get out of the trade, and then there's nothing wrong with it. Why does this stuff happen? Well, remember the U.S. market is closed for 17.5 hours, and during that time Japan, China, India all open and close. All of Europe opens and trades for 4 to 5 hours before the United States market opens. 4 to 5 hours varies because it depends if we're on daylight savings time or not. Around 8 o'clock U.S. time, Eastern time, economic reports begin, news comes out, earnings are given. All of this bottles up and affects the open, which has not traded for 17.5 hours. Note that a weekly chart would have avoided all of the issues we just discussed, or better entries would also fix the problem. There are other alternatives as well. You can use a hit and run approach on the 60-minute chart if you are not able to be with the market all day. And if you are with the market, I've always advocated that initiating swing trades with intraday positions first and selling the day trading portion is the way to swing trade. You get the best of all worlds if you're able to be with the market during the day. For those of you working a full-time job and coming home and trying to place orders to buy and sell the next day when you're not there, swing trading is very, very difficult. I suggest you back up to a bigger time frame if that's what you have to do. Feel free to contact me for any advice on that, even if you're not a DTS subscriber in any way. You can see my email down there. It's paul@disciplinedtradingstrategies.com. The website's there. It's just Paul, P-A-U-L, @disciplinedtradingstrategies.com. Scalping is fine if that's what you are doing. I find that most people don't know what scalping really means. As a matter of fact, scalping often becomes a word that people use in order to justify losing money. I'll explain what I mean by that. Scalping is not really defined, at least I don't know that it is. It doesn't matter, it's just a word, but it can range from trading a 1-minute chart to trading a tick chart or even the level 2 itself. It's really no different, but because you're using small targets and small stops, the share size must be proportionately large. Proper scalp trading just means you're taking your strategies and applying them to a very small time frame. For example, on a 1-minute chart here, if you like that entry right there, you have, it looks like about a 15-cent stop, and you take and you run the stock for 30 cents. And if you maxed out that position so that your risk amount was what you're willing to risk, you make your profit and you're doing a good job scalp trading. However, what a lot of people do is they take a normal position. They take a 15-minute chart or whatever it is, and they have this breakout play that they would look at, and they put a stop down here, and they're looking for this big target, but as soon as the stock gets going, they all of a sudden sell it. They'll say right in here somewhere. They decide to sell it right there, because it starts to back up on them and they have a little bit of profit. And even though they were risking $500, they take $70, $80 profit and say, well, I'll just do that 6, 7, 8, 9, 10 times today and I'll make my money. But that will never happen. This is what a lot of people get into, this false sense of security, thinking that risking small amounts of money is safe and just repeat the trade many times over again. But you won't do that. Trust me, you're not going to do that. There are better ways you have to learn of how to do this. This is not scalp trading. This is simply taking chicken profits as an excuse for not being able to trade properly. And finally, and on this slide, I added number 3 down here. Now, taking small profits to avoid giving back money is not scalping. It is just being chicken. You will not repeat the trade 8 times in a row. The odds of success in making money do not change. In other words, it doesn't really matter if you're trying to take a 50-cent stop and get a $1 target, or if you're trying to take a 5-cent stop and get a 10-cent target. All kinds of different scenarios can work, but it will not work if you're going for a 10-cent target. You take 3 cents all the time. You have to have a formula that works based on the charts that you're trading and your temperament and your style. I also want to mention I'm not knocking anybody who's making money. There are many ways to make money, and you could be doing some derivative of one of these and it's working fine for you. You may not agree with what I'm saying. I'm not talking to somebody who has an established system. I'm talking to a large number of people out there that I know have a difficult time and don't ever seek help. I'm here to try to help people, and maybe by identifying some of these issues, I can help you avoid them in the future. Again, if you'd like some help, you can always feel free to email me. This is Paul at disciplinedtradingstrategies.com. Hope you enjoyed this video, and as always, you can visit the other free services on the free stuff page at the DTS website. Until next time, this is Paul for DTS. Good trading, everybody.